Welcome, everybody. It's great to see you all here. We're living in a challenging time, moving away from integration, moving away from international cooperation and coordination, and we have to sustain those two things as best we can. Obviously, to do that, a growing and stable economy is going to be extremely important, and for that, we need both a vibrant private sector, but that's also working with the public sector to support things like financial stability and global cooperation, a system of international governance that works around the world effectively. In terms of how we see the role of the bank, we think it's well-suited, well-positioned to support economic development, to provide policy expertise, to support project finance. The fund, I think, is essential in terms of helping build institutional strength, especially for emerging market economies, and to assist, of course, when capital inflows inevitably turn to capital outflows or when adverse economic shocks hit their countries or hit the global economy more broadly. The private sector, I think, needs to work harder in building partnerships with the IFIs, because I think by building those partnerships, they can better support growth and economic development. Our role, the Bretton Woods Committee's role in all this, I think, is to support this mission. And I think we can do that in a number of ways. We have our convenings, like what we're doing today. We have our policy work. And as we've seen over the last 5 or 6 years, the footprint and the activities of the Bretton Woods Committee, I think everyone would agree, have increased substantially. We're currently working on 3 major agendas. The first agenda is IFI reform. How can we strengthen the multilateral institutions? How can we help them become more effective in facing these new challenges? Innovation. We want to support innovation in terms of digital finance, for example, but we want to do it in a way that it's done safely. So we think that innovation is a great thing, but it needs to be done with guardrails. Because without that, all we'll see is some financial instability at some future point, and that will be a very big setback for that kind of innovation. AI is another area where we're now spending quite a bit of energy. We think AI has quite a bit of promise in terms of its productivity benefits. Don't really know yet whether it's going to be mostly labor augmenting or labor replacing. But even though AI will be transformative, I think we also have to address some of the issues with AI that actually create some potential problems, such as bias, herding behavior as all the models converge to the same thing, cyber risks, and the threats to financial stability that might come from AI proliferation. Central thesis of the Bretton Woods Committee is that coordination is really important. It's relevant in the areas like cross-border payments. We need to sort of harmonize this regime. It's relevant in the cases of financial stability because we see how financial stability in one area can spread much more broadly. And it's certainly relevant in areas like decentralized finance, where borders are really not completely relevant to the activity. So we're continuing our work on sovereign debt, stable coins, cross-border payments, financial stability. We've done a piece on liquidity. We're going to do a piece on resolution, bank resolution this year. And this week we published our first paper in a series from the Artificial Intelligence Working Group on AI and finance, and there'll be 3 papers that follow on from that. First paper sort of lays out the landscape. Why is AI important in finance? And the next 3 papers are going to just develop that theme, examining the use cases, identifying what some of the trouble spots are, and then the last paper will propose what to do about this going forward. The AI work, I think, is going to be very, very important to have public and private partnerships. It's very important to have global coordination. And those themes we're going to be exploring in greater detail today. Thank you for coming. We're going to start our first panel now, which is going to be on innovation and economic growth, which obviously that defines prosperity and support for living standards around the world. So that's a good place to start our conversation today. So Emily Slater, who's our very able executive director, is going to lead that conversation. Thank you.
All right. Hello, everyone. Thank you all for joining us today. As always, great to see a full house at the Bretton Woods Committee event. I am very honored to share the stage with this wonderful panel here today, and I'll just quickly introduce them, and then we're going to get right into it, because I think most of you in the room likely know everybody here on stage. But to my immediate left, Shriti Vadera, chair of Prudential, long history and experience in public sector and private sector. So we are very much looking forward to your insights. You've been working in this space for a very long time and leading some really important work right now, which we'll get into. Next to her, Doug Peterson, who is now a senior advisor at S&P, former president and CEO. Thank you very much, Doug, for joining us. Looking forward to hearing more from you about some exciting initiatives. Next to him, José Viñals, a special advisor at Standard Chartered, just stepped down as former chairman of Standard Chartered, also on BWC's board of directors. So thank you, José, for joining us today. And finally, at the end, Natalya Thakur, founder and CEO of Nova, also on BWC's advisory council. So delighted to have BWC leadership represented on the stage today. Okay, let's get into it. I think Bill gave some nice opening remarks, kind of set the stage for what we're going to discuss here today. We have an excellent panel of all private sector leaders who are going to share a little bit about what the private sector is doing in coordination and collaboration and in partnership with the public sector to drive innovation and growth. So I want to start with just a little bit of a scene-setting conversation, scene-setting question from everyone, and hear your response to sort of what do you, as business leaders, think are the most promising opportunities right now for the private and public sectors to work together to drive innovation and growth globally? Maybe we'll just start, Shriti, and then go down the line.
Okay. So I chair for Ajay the World Bank Private Sector Investment Lab, and our main job, I used to co-chair it with Mark Carney, but he left for some reason. So,
something small.
Something small. So the mandate was to support the World Bank in increasing the leverage from the private sector that they get for every dollar that they spend, and in emerging markets. And that's really been the sort of core work for the last 2 years. We met this morning, in fact, and we have been working on 4 areas largely. Obviously, making a working assumption that the regulatory and policy certainty exists, because that is the foundation of everything. And we've seen, that's the core job of the bank in any case, and the fund. But the first area we worked on is guarantees, and how we can increase the level of guarantees that are provided that leverage a higher amount of private sector finance. And I'm really delighted that a single platform for guarantees was created by the bank, and that has been growing rapidly. Already in the last year, we've seen the results of that, and there's a target, which I'm sure Ajay won't thank me for saying, but I would like the target increased. And the target is to treble the level of guarantees annually by 2030 to 20 billion per annum, but I think they can do more, and that's going well. The second area is the most problematic area for all investors, which is FX risk for all long-term investors. And this is a really hard nut to crack, because it's just so related to macroeconomic issues. And so one of the things that we do need to talk about is the development of local capital markets and the increase in local currency financing, because it's just really otherwise very, very difficult for long term. The third is the biggest gap proportionately, not in absolute numbers, is in equity. It's the start of any capital stack and has the highest level of leverage you can get from the private sector. But unfortunately, the shareholders of most of these of the bank and other multilateral development banks always view this as too high risk without looking at the outcome that it can produce. They're just looking at the input and saying that's very high risk, usually without sufficient data to understand what the probabilities of default are. So we would really like to work on that, and particularly around catalytic equity in particular. And then the last area is the nearest thing to the Holy Grail, in this world that Doug is wonderfully leading for us, which is a task force called Originate to Distribute. And when we talk about private finance for growth in emerging markets in particular, what we're really talking about is tapping into the trillions that exist in institutional capital. And we can't do that currently because we do not have a liquid, tradable, deep market. And that is what big investors need. And that is where the money is, because you know what? They ain't getting out of bed for writing less than $1 billion check, and they need it to be tradable, and they need it to be rated, they need it to be easy. They're not going to sit there doing due diligence for 2 years waiting for some, approval process, etc. And that is the market we need to create, and that is why the IFC's CLO that was issued last week is the first. It's just the first that we need it to be, but we need scale. We need standardization, not just within the within the World Bank Group, but with all multilateral development banks, because we need scale and volume and regularity and harmonization to create a new asset class. That is about the only thing that is going to get the level of financing that we are talking about from the private sector. And
well, a great segue, I think, over to Doug. Do you want to share a bit more about this labor of love that has been 2 years?
But let me start with a broader context. You asked the question of what are we seeing in the markets? Why do we need so much capital? And where do I see a lot of discussions? And let me start with this electrification of the world, the energy and the energy transition. Everywhere I go, I was in Asia last week, and in every meeting I had, somebody was talking about energy transition. Data centers are going to require a whole new source of energy. And you go to the emerging markets, and what are we talking about? Energy, the need to grow economies for electrification, so you can have rail, you can have cell phones, you can grow your economy. No matter where you go, there's something happening with energy. And energy includes power. It also includes metals, critical metals. And so this is a huge financing need globally. If you go anywhere and you start looking, what is the gap that's there between that need for energy transition and what capital is available in traditional sources, you find this gap. And so this is why the project that Shriti's leading with Ajay Banga at the World Bank is so important. And then I'm leading a subpart of that, which is the Originate to Distribute, which takes a step back and says, how can we leverage and scale the capital of the multilateral development banks, starting with the World Bank, and make that capital multiply and find velocity on it instead of putting loans on a balance sheet for 25 or 30 years? Can you make those loans and sell them? Can you make them in forms and structures that they can be sold? And so we have some new success with this first securitization. It's a CLO structure. What we've heard from the investors that bought it, they want more, which is great news. So the securitization of $510 million of private sector assets from the IFC's balance sheet, the investors have said, we want more of this, and to get more of it, they want it to be structured in a way that you have that standardization, like any securitization, that you're going to have consistency, repeatability, you're going to create liquidity in the market, pricing, a pipeline of deals, et cetera. That's what creates an asset class. Along with that, there's two other sub-projects we're working on. Another one is, as we're meeting with investors, there's some investors that say, well, I'll just directly buy assets. Think of it more like a loan syndication. Somebody that says, I see that you've made a loan to a power project in a country, and I like that kind of asset, I'll buy it directly. It's kind of a pass-through structure. And then the third structure we're looking at is more of a fund structure where you pool assets and then issue bonds against them, or you have some kind of commitment for funding commitments over time. One of the best things about this project is the number of organizations that are saying, I want to be part of this. It's something, we're a coalition of the willing. It's coming from institutional investors, from banks, from investment banks, from individuals. And we'll talk more about this during the afternoon, but I'm really excited by all of the people that are stepping up to want to help.
Jose, let me turn to you next. What do you see as some of the most promising areas for private-public collaboration? You're involved in many different initiatives. So tell me a little bit about what you see in the landscape.
Well, thank you very much. And I cannot agree more with what Shriti and Doug have mentioned. The world is in a situation now where growth is low. Compared to historical averages, and what we need is higher growth, and growth can only come from innovation. and from investment, which increases productivity growth. So this is the first idea. And in advanced economies, a lot of this can come just, spontaneously by the private sector. And you don't need the public sector. I mean, you need the public sector from the point of view of providing solid policy frameworks, which provide regulatory clarity and all that, something which is not always guaranteed, but at least you need some rules of the game and then private investment flows. But when we talk about emerging markets and developing economies, the situation is very different. And this is where you need the structures that the private sector investment lab has been working on, and Doug's group on securitization working on, in order to make sure that you have bankable projects and that you have also appropriate financial structures or structuring of projects, which makes it attractive to institutional investors. And I think that the beauty of what has happened with the CLO that you have issued recently is basically trying to overcome the problem that all of those that have been involved for the last decade in the area of blended finance found, which is that blended finance is a beautiful tool. It can make wonderful things happen, but it's bespoke. And it takes a lot of effort to finance just a single project in a country. And there is a lot of idiosyncratic risk that cannot be diversified away, and therefore it's harder to get a multiplicity of bankable opportunities. Now, with the structures we're talking about, what you go is from a project approach to a portfolio approach, where you have portfolios across sectors, across countries, and you have multiple risk diversification. And for institutional investors, if you get those, asset packages, and then you have structuring so that you give to the most sort of risk-prone investors the junior piece, and you have the mezzanine piece, and then you have the senior piece to institutional investors who want investment grade, then they want to buy it because it's something which is attractive. They don't want to invest one project here, one project there, but they like the package. And that's precisely the key to scaling up this financing for development, which is to provide these asset classes which are consistent with the risk-return parameters that govern the behavior of institutional investors. And then this can be scaled up. And I hope that you can do more of and more frequently of those things. But I think that there are other platforms that can be built alongside that. I think that this is a great role model that will be followed by others, other multilaterals and other partnerships that we can see. Now, two other issues which I want to mention, which are particularly important in order to remove some of the barriers that prevent these things from being even more more scalable, have to do one, in addition to all the policy issues that you can think of sounder national policy frameworks to diminish macroeconomic political risk and all that, that's fine. But there are two things which are very important in my mind. One is the issue of regulation. And that's something that we need to reconsider. And having spent a good part of my time in the fund, taking part in the process of helping overhaul financial regulation after the global financial crisis, I think that this has served the world extraordinarily well. Okay, but it's true that with the passage of time, there are certain aspects that may be necessary to review to see if some of the perceived amount of risk which exists in some key parameters for capital and liquidity in the prudential standards are consistent with the actual reality. And for that, you need data. You need data like the GEMS database. You need data based on the micro sort of experience of financial institutions. So there may be some sort of recalibrations at the margin that may be helpful going forward in order to make these structures flow even better. And then there is another thing, which is the local currency risk. And there is some risk which is non-diversifiable. And I think that, again, that's an opportunity for the private and the public sector to collaborate, because if we look at the financing which is provided by multilateral development banks, regional development banks, the majority of it, about 70%, is in a hard currency. And when you have domestic projects which generate local currency revenues, then you have a mismatch, which generates a vulnerability. And you don't have, unfortunately, the hedging instruments in many of these economies to be able to avoid that mismatch. So here is an opportunity for private and public partnerships, which is ongoing. For example, I'll give an example of Kenya, collaboration between the International Financial Corporation, IFC, and Standard Chartered, where instead of Standard Chartered buying the bonds of the country, which provide good return, but high risk weights when our home regulator, the Bank of England, the Prudential Regulatory Authority, look at them, we provide financing to the IFC in local currency, which then lends the money in local currency to the government, and we benefit from having zero risk-weighted assets because the IFC is not the government of Kenya. So the country wins, the IFC is fine, and we also win. So I think that is an opportunity for the sort of collaboration you need. So in order to scale these things up, what you need is two things: more collaboration and more imagination. And a lot of it, I think, is going on now.
We're going to come back to several of these themes that have been raised, but I want to turn to Natalya, who brings a little bit of a different perspective to this panel, who brings in more of sort of the fintech and sort of emerging finance and innovation lens. So, Natalya, I mean, we've talked a lot about some of the initiatives going on at the World Bank and some of the innovations in financial instruments and more traditional financial products. But what do you see from your perspective as some of the most promising private-public collaborations?
And here come like the buzzwords. So, I mean, from my perspective as a technologist, everything that we're seeing as for promising growth is in digital assets, and especially like post-Genius Act passing, and then in AI. And probably two words people are maybe tired of hearing or are very interested in hearing more about. But I think the growth catalyst isn't necessarily just from the tech itself. We don't talk about what is the underlying growth catalyst underneath that technology. And I think it's really about unifying data and information. So specifically unifying information in real time across different types of AI agents, or unifying information across different stores of value, whether that value is held in cash, treasuries, stables, or whatever, tokenized fund or deposit is of the flavor. And when you think about that concept of unifying data and information as the catalyst for growth, you're really thinking about, okay, how do we actually achieve interoperability? How do we achieve accessing this data in more real time? And really moving against the grain on all of these fragmented systems that have allotted us with very different data sets that now we need to sort of like figure out how to use AI agents or how to use digital assets to pull that information together in real time for us to actually make better decisions in how we allocate capital. So what we've seen is that investors in the space are moving away from investing in interfaces, but investing in infrastructure. So that infrastructure could be programmable financial infrastructure, right? So tokenized funds, stable coins, or tokenized settlement and custody services. That could also be on the AI side. Obviously, AI has a multitude of applications, but let's just talk about it from a financial perspective. So AI for transaction management, can you predict liquidity requirements for a bank, or can you automate certain consolidation efforts between cash assets and yield assets? And so when we think about those two prospects, then you kind of move into like, okay, well, how does this basically affect the public and private sector partnerships? Because a lot of AI and digital assets is being driven by the private sector itself. I think the collaboration with the public sector then comes at the intersection of saying, okay, if we're really focused on new infrastructure plays, then the public and private sector should be in charge of coming up with standards that actually support those infrastructure plays. And I actually think the standards really should be focused around, like, again, managing data and interoperability methods better, so that that data can be more useful for the decisions that are driven by a lot of like the organizations that are represented here on the stage.
Natalya, I want to stick with you, and then we'll get back into a little bit more of some of the lessons learned from everyone's experiences with these private-public collaborations. But you've been involved with the BIS Innovation Hub, the World Bank Innovation Lab, the G20 Tech Sprints. I mean, can you give the audience and give us a sense of sort of what your lessons learned from that are? I mean, these are kind of, enablers for technology and innovation. But I hear a lot from the fintechs that it stops at pilot and we don't go to scale. So
I love this question.
Can you tell us a little bit more about what your experience has been?
So I think when we think about like World Bank, G20, BIS, like they're really connecting with private institutions and technologists to co-build or crowdsource or set standards. So those are like the three principles. I'll talk a little bit about what we saw with the World Bank and BIS and G20, and then some of like the pros and cons of these public-private sector partnerships. So with the World Bank, essentially they have kind of a standalone innovation lab that's really focused on doing one-off small tests, POCs and pilots within the emerging market sector. They actually recently did something that like felt a little bit more than that, where they were actually, it was called Bond Eye. It was a project where they basically showed a full bond life cycle using DLT technology. And a lot of private sector banks and institutions were very involved with that. And so that was something that was like more highlighted versus a lot of like, we've worked with the World Bank a couple of times, and it's been a lot of, POCs and pilots, and they take that data and they create some sort of like report, right? But then how does that actually get to impact is a little bit of like a longer story. Then you have the G20. So the G20 works very closely every year with whoever is leading the G20 presidency to run something called a tech sprint, where they pull together hundreds of technologists, and they end up picking like a top 10, and then they end up picking sort of like a winner for that. And those technologists are brought together to essentially talk through some of the technology implications and ramifications. They build specific pilots for the tech sprint, and then figure out how can that be applied to what the G20 is doing around their SDGs. So usually these tech sprints are focused around payments and open finance initiatives, digital identity, and fraud prevention. And the G20 partners actually with the BIS to put this together, show all of the technology specialists, and then obviously there's follow-up with a lot of the different central banks and involved with the BIS and with the G20 as well. And so it's great exposure, and they actually track all of those companies over multiple years after the tech sprint, and it's pretty incredible to see the cohort of people, what they've done, where they are today. And so that exposure is helpful, even if things sit at a pilot, they might be put into production in specific banking systems that they're introduced through the tech sprint. And then finally, the BIS, it's probably no secret, they have done the most, I would say, in this space. They, a few years ago, launched the BIS Innovation Hubs. And for those of you that don't know, this is a completely decentralized system. So every BIS Innovation Hub is its own sort of like company, its own hub. They have their own set of like leadership team, own set of technologists. And they are basically funded to experiment and pilot a bunch of different things with their technology vendors of choice. So there's not actually like a headquartered tech team at the BIS that is running this. It's like all the individual tech teams that BIS Hong Kong Innovation Hub hired, or BIS Singapore Innovation, and they usually work with their responding central banks. And from my perspective, I think, I hope the BIS Innovation Hub kind of moves towards also having some sort of headquarter, because if you have a headquarter system, you'll be a lot more involved with, I think, some of like the open source initiatives that I think are required at the central banking level and the larger institution level from a technology perspective. But the BIS has actually done the most to move from POC pilot into actual production systems. So I'll give like a few examples. So Project Enbridge, this was like a cross-border digital currency project. they actually went into a real MVP, which was pretty big. And that has the support of multiple countries kind of working at the table together. Project Nexus was another recent one that was focused on domestic instant fast payment systems and connecting different instant fast payment systems. And so they are going into implementation as well pretty soon. And then the one that's been probably mentioned the most at this conference this week, if you guys know people from the IIF, is the IIF and the BIS are working together on a project called Project Agora. And that is like their flagship project. It's across 7 different countries. And what they are basically doing is they are bringing together some sort of like interoperable multi-asset system where you can, between countries, send CBDCs, tokenized deposits, et cetera. And so it's a massive initiative. We'll see if that actually gets past POC and pilot stage, but they definitely are putting in the work to make sure that like something real comes out of that because it's so much effort put in. In terms of like pros and cons of public and private sector, I'll just touch on those super quickly. The pros is that, what we've seen is that these public institutions are really kind of setting the stage and bringing together the convening of different technologists, and that the technologists are left to do what they're good at, which is creating, testing, building, and scaling for each project. And beyond, even if you stop at a POC or pilot or you go beyond, what's nice is that some of these projects have created a lot of open source code and APIs that can actually be productized and used by multiple public and private financial institutions in the future. So like the creation of open source tools from these projects is great. On the con side and disadvantage side, I would say that, to be honest, like was mentioned, a lot of things don't come out of pilot. You can't actually get to production. And so the advice that we've given a lot of different larger banking institutions is you should take a pilot, you can break it into chunks, and you should put each chunk into production consecutively over time. You don't need to put the whole thing into production at once. It's too much of a lift and too much of an ask of so many different stakeholders. And then the last is funding. So running a pilot and running a production-based system requires a ton of more capital. And usually those capital funding and how they come together are not necessarily aligned for everyone's incentives. I think the funding structure needs to be a mix of development capital from the public sector and the private sector as well to get those projects up and running.
So picking up on some of the lessons learned that Natalya just described, I think these are applicable and there's parallels across, probably you all have experienced them throughout your career, and Natalya's, and the kind of fintech and technology sector is starting to experience some of the same challenges that, the rest of us have experienced, in terms of working with the multilaterals and public and private sectors for decades, most likely. So maybe, Shriti, Doug, tell us a little bit about lessons learned so far, successes, challenges, biggest obstacles, and the work that you've been doing with the Private Sector Investment Lab and with the CLO. A lot of this stuff we've been talking about for decades, right? So how do we get this unstuck? What have been your biggest learnings?
Well, I think I should start with, we've obviously been talking about public-private partnerships for decades. I think there's a real opportunity at this point in time for a negative reason, but there it is, which is there is no choice because of fiscal pressures in particular in developed markets, but of course also fiscal pressures in emerging markets. So, if we want to make this work, there is only, if we want to create the financing mechanisms for the sorts of investments that, we've talked about that are needed, we need to make this work, and that's it. It's the last chance saloon. So, I think there is an opportunity. For me, the biggest obstacles are culture. There's a pilotitis issue, an issue of everything is bespoke, an issue that's not invented here. And that is, we are not in a position to indulge in those inefficiencies anymore. And I love the fact that, Ajay's come in and has provided a clarity and a direction and a kind of, a force behind this, and so that is our one chance to get it right. To not be one of the things we've talked about is scale and volume. Say we take the CLO issuance. Actually, we just need, the last time it was done was 1994, and honestly, we can't wait another 32 whatever years to do the next one. We need to be doing it within months. And that needs all of the multilateral banking system to come together, not worry about where it was invented, to standardize their documentation, to get on and pool it and issue it. That is a significant cultural change. And so I guess for me, this is about whether, I know that Ajay is up for this. Today we were joined by Odile Reynaud-Basser from the EBRD. I know that there's conversations going on. There's been a mutual recognition around due diligence that has been done by the multilaterals. So there's some really amazing signs. But there are also shareholders. They're common shareholders. This is what they should be demanding and enforcing as well. So it's not just for the multilateral system to, try and sort of, self-generate it, if you see what I mean, to get the scale that we need. So I would say that's probably one of the biggest lessons is to work around that. The other thing, I do want to talk about local capital market development, because when we talk about the scale of financing needed, actually, we all know that the majority is going to come from domestic sources. It's not cross-border, it's domestic. And yet these markets stay incredibly shallow and undeveloped in the main, with very notable exceptions, of course. And that is because of regulatory issues. So if you have natural demand from insurers and pension providers because they've written 30, 40-year liabilities, they need to have a match in the asset class. They need to buy 30, 40-year securities, bonds from the local market. They are incentivized and sometimes mandated to only buy sovereign debt. And that stunts the creation of the domestic market, as opposed to create the foundation for the market by actually being there as the natural buyers and creating something that is very unusual, which is long-term, and that reduces volatility in capital markets. So that is a regulatory issue that can be fixed by all of the regulators having the confidence to know that if they create a liquid market, they will be able to finance both the sovereign debt and the infrastructure, both of them. Yeah. There's regulatory issues that José has mentioned. If you have a guarantee from the World Bank system, you could still have a very high capital charge. That's ridiculous. Natalya talked about interoperability of data systems. Actually, it is around regulation and the fact that there are no interoperable data laws around the system. This is regulatory change. So I think the second area I would say, one is culture, and the second is the regulators really need to get with the program and sort of update themselves and stop being analog.
And let me come from
Doug,
let me come from two different angles and start with public-private partnerships, with the view of what we're trying to do is create jobs and create growth. Yes. And there is a need for public-private partnership laws that actually work. There are not that many countries that have public-private partnership laws that work. In fact, just in this country we're sitting right now, there's only 17 states that have effective public-private partnership laws which allow you to build a project that is operated or sold or transferred between the public sector and the private sector. One of the barriers I find is that too many governments think about investment in infrastructure as an expenditure, not an investment. And they look at it how it's going to go into an annual budget process instead of thinking about it as a much longer term investment, which is going to create jobs, it's going to create an opportunity for growth, it's going to create a positive benefits that are going to impact the entire economy. So I think that infrastructure and this public-private partnership is such an important aspect of what we're trying to bring the financial capital to. And in addition to the financial aspects that I'll go to, we also need to think about the legal framework beyond the financial system as well. How do you facilitate investment, and how do you facilitate the investment in infrastructure? Now, some of the barriers that Shriti's spoken about, let me just get a little bit more granular, because we've looked at as we're trying to put together together these coalitions of the private sector and the public sector for bringing the financing. And for those of you in the room that have been bankers at some point, it goes all the way down to the documentation. What law are we using? Is it New York law? Is it London law? Is it somewhere else? There's no consistency on how you choose that. What is the interest rate? There's so many different kinds of interest rate you can use. And is it SOFR is now becoming a standardized US dollar rate, but you use a 3-month, a 6-month. Some people want to use a longer or shorter. What kind of documentation do you use around the collateral? Is there documentation about how long the loan is? And what you find is that the organizations that want to accommodate both the borrowers and the investors start putting together a bespoke product, bespoke loan, and every single financing is done in a way that you can't find somebody who's going to invest in it because none of them are the same. And if you look at a market which is a very liquid market, something like CLOs or CMBS or something that's done for real estate or commercial receivables or credit card receivables, those types of loans are made in a way now that they're completely standardized. Every single time there's a credit card receivable, every single loan that's in that receivable package is standardized in a way that you can be sending and selling credit card receivables every day. So we have to get to a point where we have to just bite the bullet and say, sorry, we're not going to allow to have all of these different types of terms and conditions in a loan. We need to start standardizing it. And what's going to be the benefit for somebody in the World Bank or one of the multilateral development banks? They're going to be able to make the same type of loan and have an impact that's going to go 2, 3, 4, 5 times what they're doing now, because you can recycle that capital and use it over and over and over. So we have to get through the barriers that Shriti mentioned. We have to actually go into the devil of the details and look at all of the details in loans and loan documents and standardize them and make sure that we see one single approach to the market. And if we can then spread that across all of the MDBs that have the same shareholders, that will be an amazing start and keep up the momentum that we already have.
So Doug, if the demand is there, when's the next one coming? When's the next CLO coming?
33 years?
Yeah, another 33 years,
Well,
as Shriti said.
there is, first of all, there is another CLO underway, so they're working already on the next one. And then the success of this has brought a lot of interest from all of the other MDBs. In addition, there have been some other CLOs in Asia that have been put together by the ADB and the IAAB into the markets. Those were a little bit shorter term types of assets. So there's a lot of innovation taking place around the world, and we need to tap into all of that. But I'm very encouraged that the other MDBs are looking to this and want to get in the same momentum for issuance of new CLOs.
Jose, I want to pick up on, Shriti mentioned, sovereign debt issuance, and something that is, near and dear to your heart. So wanted to see if you wanted to respond at all to, some of Shriti's comments in terms of developing the local capital markets, and then also hear a little bit from you. One of the main initiatives of the IMF with the private sector that you were involved in when you were chair of Standard Chartered was the global sovereign debt roundtable. So maybe if you could share a little bit about your experience from the private sector side with that roundtable, the progress that they've made, lessons learned, challenges along the way.
Okay, thank you. Well, just a brief footnote to what Shriti said. I think that the development of local capital markets is extremely important for the reasons that we are talking about here, in terms of having the depth to be able to provide the finance which is necessary for domestic projects which are important for the growth of the country, but also very important for a host of other reasons, yes, including the resilience of the, yes, market and so on and so forth. And we have very clear historical examples of emerging markets that have developed their local capital markets, and that has contributed a lot, not only to their growth, but also to their macroeconomic and financial stability. So I think that as long as you have a diversified base, it's extremely important. Now, going back to the question of GSDR, I think that we have been talking so far about the collaboration between the World Bank Group and the private sector through the experience of the Private Sector Investment Lab. There are other examples of collaboration, and the one that you bring up of the Global Sovereign Debt Roundtable, which has been sort of launched by the presidency of the G20 together with the IMF and the World Bank, about 2.5 years ago, I think is another example of this collaboration. And this is a good thing because if one looks at the problems that the world faces and the international financial architecture, the issue of the debt is an important one, the public debt. Of course, we have public debt, which has been increasing in advanced economies, but where the thing has been most vividly felt has been in low-income countries and middle-income countries, which have gone through very difficult episodes. And that is, I think, where the Global Sovereign Debt Roundtable has been focusing. It's an inclusive conversation, bringing in not only the creditor countries and the debtor countries, but also the private sector being represented, the banking sector and the non-banking sector there. I think that this is important. And I think that during these years, there has been some important progress achieved. That progress has not had yet so tangible results in terms of its main purpose, which is speeding up the processes of debt restructuring. But I think that there have been some important things that have been achieved and that with the passage of time, I think we'll be able to play a bigger role. I think there have been agreements on things like the perimeter of debt restructuring. There have been agreements on the need to share information early between the public sector and the private sector. And when I say the private sector, not just to bondholders, but also to other commercial creditors which are non-bonded or holders of non-bonded debt, like banks providing commercial loans or other commercial creditors which are not bondholders. That information sharing at the early stage from the point of view of the IMF, sharing the key parameters of the framework under which a program is based, the debt sustainability analysis, providing on the part of the debtor country early information on how they want to go about restructuring to all of the players, both the official creditors and the private creditors. The official creditors, once they have agreed something, sharing that information immediately with the private sector. All of these things are now part of the conversation, and things have been moving forward. Another thing which has been important is an agreement on the comparability of treatment, which is very important in these debt restructuring processes between different parties, between the official creditors and the private sector creditors. That's also something that there's been some agreement. But where things are not yet satisfactory is on a key issue which has to do with transparency, debt transparency. And this is something that complicates enormously the debt restructuring processes. I think that one of the things where progress needs to be made, and I think that this is going to be happening hopefully over the coming months, is on the treatment of non-bonded debt, basically bank loans and other loans which are not in the form of bonds. Because bonds have collective action clauses which allow them to come together faster. But when you talk about bank loans, you don't have those provisions. So it's much more complicated. And, there are also issues regarding the fiduciary responsibilities of banks. And therefore, that's part of the conversation that needs to happen in the coming months. But I think that it's good to have these sort of conversations and to try to move forward in this domain. And there are other initiatives which have joined the Global Sovereign Debt Roundtable, private sector based, like the London Coalition, where we aim also to make progress by complementing those efforts.
Yeah, Doug, maybe just to pick up on that, I mean, ratings agencies are an important part of the sovereign debt architecture. You want to share a little bit about your experience with the GSDR and...
Yes, so when it comes to rating agencies, and obviously I cannot speak on behalf of the analysts, the rating agencies have a very transparent approach to working with the markets by having a criteria. Over the last 15 years, after the financial crisis, the rating agencies spent time understanding what were the implications of the data which came out of the financial crisis, what were the implications of the different defaults that took place, what were the different types of asset classes that had problems, and then they've gone back and completely reiterated and iterated on their criteria to ensure that they're issuing relevant ratings and relevant criteria and relevant methodologies. In this case here, it's very important that the rating agencies are part of the dialogue because of the definition of a rating, especially when you get to a default rating, and what that can mean for a country at losing access to the capital markets. So it's really important that the rating agencies are gathering the data and they're part of the dialogue.
If I may add something to what Doug said, which is very important, we have seen a number of restructurings recently where there is an agreement between the IMF and the country on the program, where the official creditors are in agreement, where the private bondholders are in agreement, but the rating agencies do not take the country out of default because you still have the non-bonded commercial debt basically provided by banks not restructured, because that has been left to the end of the process. And therefore, the country cannot get out of default. And then the banks, you cannot continue lending to a party which is in default because you cannot do it under your rules. So that's why it's very important to have this debt restructuring so that not only the private bondholders, but also the banks and other non-debt holders come earlier, the information sharing processes and in the creditor committees, so that these things can happen faster, so that the credit rating agencies can take the country out of default when they consider the restructuring completed, rather than these things dragging on because the country suffers because they don't really regain market access fully.
Shriti.
I just wanted to say about the other end of the spectrum around sovereign debt and indebtedness in the current environment. Jose is talking about an end where we all work and have some familiarity about certain emerging, developing and low-income countries that have debt distress. But we are in a very different world right now with extraordinarily high levels of indebtedness in the developed market. And some of them, we do talk about them showing emerging market characteristics, shall I say, which personally I find a little insulting for emerging markets. So we just need to think about how the rules might be rewritten if there is, other ways of dealing with developed market debt, including, financial, repression and other things. And the second thing I want to say is it is so important, everything that we've been talking about, getting the perception of risk in emerging markets to match the reality better. And one of the common themes of today's discussion, Doug, this morning was really around data and the matching of data. We've got the GEMS database, which is fantastic, but there's also a private sector database around this, and they do need to sort of match up and show whether there are gaps in that perception reality mix. And in particular, we talked about the performance. If you're doing an originator distributor or any of the other structures that Doug has talked about, it's the underlying portfolio's performance that we need to understand. It's the debt security that's issued that we need to understand. It's the equity piece we need to understand. And so I think there will need to be some form of public sector starting of the compilation of the database, which would eventually then be taken up by the private sector, because the gap is real between perception and reality in emerging markets. Emerging markets have been much more resilient in the recent crises than anybody has imagined. The capital flows have been lower, the debt ratio is lower, and in fact, the problem is frankly on the other side.
Yeah. Why don't we finish up with one question to everyone to kind of conclude here? I mean, I think the key themes that we've heard throughout, I mean, whether it's World Bank, IMF, BIS, public-private collaboration, is this pilotization issue that you said, Shriti. Everything is too bespoke. Nothing can be done at scale and speed. Regulation needs to be right-sized. Coordination amongst the system needs to be better. A lot of challenges. Again, we've been talking about many of these challenges for decades and decades and across various institutions. So maybe last round, what is the one recommendation, one action that you all would suggest to be able to move forward and move towards more action and less talk? Who wants to start?
I'll start. I'm going to start
brave.
by echoing something we've already heard about, especially since I want to address these thoughts to the developing markets, the emerging markets, and that is, we've already talked about developing domestic capital markets. And let me just give you another reason why we haven't talked about it yet. We did have one, you've said a couple comments about CBDCs and digital currency, but we know that there's a lot of interest in what's happening around the globe for digital currency and central bank digital currency and what we're going to be seeing in new payment systems. And in order for developing markets to have a lot more credibility in those types of fields, they're going to have local regulatory capital markets and banking systems. And I think it's getting more urgent than it ever was before because of these new types of payment systems and digital currencies that are taking place. And one of the areas that, going back to José's comments, I think they also have to have the local bankruptcy laws. You need to have some sort of a resolution or recovery or a bankruptcy or whatever you want to call it in every country, because I think of that as controlled failure. And when you have controlled failure, it's a lot better than for some sort of a horrible failure or failure that never happens and ending up with zombie systems. So my answer to your question is, let's put a lot of emphasis on developing domestic capital markets. And let's also be much bolder than we have been.
I can go from, maybe I have like two comments, but on the multilateral public sector side, I think from a funding perspective, you need to stop thinking about like your innovation labs or your technology labs as like these offshoots. Yeah. Like they need to be well funded, and you can't think of it as just like you incentivize people by saying you completed, a project. Like that's not business. That's not how things are going to get actually down to the developing markets and have this tech actually be used for what it needs to be used for. So I think there needs to be a totally rewrite of the incentive strategy and funding strategy of like innovation arms. I think on the private sector, what they really need, and this is coming mostly from talking to TradFis, where until recently it was like really easy to gather information, but not really easy to take the first step, right? A lot of them have decision paralysis. There's like so many technologies, and like even with like digital currencies and stuff, it's like, where do I start? Like what ledger am I using? What type of digital asset am I even looking into, right? There's this horrible paralysis, and I think technologies or products or things that allow these private sector institutions go from 0 to 1 in a quick fashion, but also don't allow them to have vendor lock-in, I think are really the responses here, because even as, if a bank makes a decision today to say, hey, I'm going to work with these stakeholders, or this is the strategy that we want to test, the technology is moving so fast that actually in 6 to 9 months, like that's going to be maybe a completely different set of vendors or types of assets that they want to work with. They should be working with flexible architecture that doesn't lock them into certain vendors too soon, because that's this paralysis. There's too many options, and I don't want to have vendor lock-in and make the wrong decision and then have my neck on the line for it, right? So actually a lot of what we've been doing is helping provide that flexible architecture so that people don't have vendor lock-in. You can make decisions now. You can start testing it in real time. You can go from 0 to 1. And if that thesis changes in a year or 2 years because the digital asset market is moving so quickly, you can plug stuff in and out pretty easily.
Jose?
Maybe two things, one at the national level and the other at the international level. At the national level, for developing economies in particular, which are the ones which have more difficulty in generating domestic investment and attracting foreign investment, is institution building. The example of bankruptcy law that you were mentioning, Doug, is very important. We can add quite a number of institutions which are extremely relevant for these countries to be able to generate the volumes of domestic investment, to attract foreign investment, and to have the right sort of structures to channel, to allocate this capital efficiently. So that's something that we don't have enough of, and we need to have more of at the national level for these countries. And the other is at the international level. Rather than building institutions, do not deconstruct some of the institutions that we have. And one which I'm particularly interested in and concerned is about the multilateral trade system. And still today, even with all the noise, global trade is being conducted under WTO rules in about 72% of the cases. But it used to be 80% at the beginning of the year. So it's come down. And that is extraordinarily important, having an open trade environment and a larger market for everyone, but particularly for those countries which need to plug into international trade circuits in order to move forward. I'll give an example. E-commerce. E-commerce is a fantastic vehicle for the promotion of small and medium-sized enterprises and for inclusion in global trade circuits. In the WTO, they have an e-commerce moratorium that they have been renewing every 2 months, but because there are some countries which object, now they're coming to a sunset clause, and they will have to decide in a couple of years whether they make it permanent or kill it. And if they kill it, this e-commerce no tariff situation, that would be a big backlash. So there are all the beautiful things we're talking about in terms of digital, AI, chips, and so on. A lot of the world would not have access to, really. So again, do not deconstruct the institutions that we have built and that which have served the world so well. Sorry.
We might need to end there, but I'm going to give Shriti the final word.
I'll be very brief.
We don't want to.
I'll be brief because I think I've made my views quite clear. I think it would be the creation of an asset class that is both cross-border and domestic, that requires volume and scale of issuance, that requires harmonization and standardization, that requires a change in culture in these organizations and with the regulators.
And we're on our way.
I think so.
All right. Join me in thanking all of the panelists very much for their insight.
Thank you.
Thanks.
All right. Let's keep the show on the road here. I'm absolutely delighted. I guess I should introduce myself. I'm Rebecca Patterson. I'm Vice Chair of the Bretton Woods Committee. I'm absolutely thrilled to be here today with World Bank President Ajay Banga. And we're going to spend the next half hour or so talking about how he's transforming the World Bank, right? Easy, no pressure.
That's the setup?
Yeah, exactly. And you're going to explain step by step how it's happening. So, I grew up in the private sector. I'm coming down today from Manhattan. And when I think about multilateral institutions, the word efficiency doesn't always come first to mind. But I feel like one of your North Stars for the World Bank has been creating efficiency, not just in name, but in execution, in the day-to-day work of the World Bank. I think we heard about it last week with an internal reorganization that was announced. We are seeing some evidence of it, but I would love for you to give us a progress report, because we know that changing a culture, changing the inner workings of any organization, private or public sector, is really, really hard to do. So how are you doing it? How's it going?
Aside from my envy that you just came from Manhattan? No,
it's overrated.
That's where I live, for God's sake, on weekends. He lives there too. First of all, thank you guys for having me this evening again. Part of every one of these meetings we get together. The efficiency question has got lots of parts to it. I'm going to pick 3 or 4 that I think are the most interesting and substantive. And the first one is, it used to take us 19 months on the average to get a project from discussion to approval by the board. And if you think about 19 months to get from discussion to approval, and that's before you start construction, then if you think about a democratically elected government at the other end that's got 4 to 5 years in its term, you're 2 years into the first term before a project is approved, let alone before a shovel breaks the ground. And to me, that's an inappropriate way of working with this topic. You lose people's attention. So we've gone now to 19 months is down to a little over 12 on the average already. But inside the 12 are projects that I don't think I can speed up, like a hydroelectric dam which will take 3 years to get approval because it's complicated in its construction, but also its environmental and safety kind of challenges around a hydroelectric dam. Important, but difficult to do, high risk in that sense. And then there's health clinics in Kenya that are getting approved in 30 days. So I want more of the 30 days ones to come through, but not at the cost of chasing a number down on a weighted average basis. Trying to get the right thing done here is to get to the right combination of this mix. I think somewhere around a weighted average of 10, 11 months will be a good number, and focus on a bunch of projects done and approved in 30, 45 days, and a bunch that take longer.
So what specifically, what specifically did you have to do to move the needle there?
You have to do, first of all, a risk-adjusted classification of how much in-depth investigation from environmental and safety frameworks do you need for a low risk, like a clinic in Kenya versus a hydroelectric dam.
So right-sizing the work
Yeah,
for
we
each
used to kind of do
project.
one size fits all for that, this kind of stuff. Second is the number of people involved and clearances. As you know, in all institutions, private and public, people tend to get involved beyond what need to be involved. And you've got to just sort of...
Shocking.
Yeah, you've got to make sure that you remind people that they don't need to be involved in this one. And then it does lead to a catharsis.
Yeah.
So there's that going on, and a mix of those kinds of things. The second thing that is interesting, which people used to complain about, is, the World Bank Group has got 5 parts to it. There's the IDA, which is the poorest countries, IBRD for the ones that have come out of the poorest situation, IFC for the private sector, MEGA for guarantees, and ICSID for the settlement of investor disputes. And as you can see, we love our acronyms, and we have a vice president for acronyms hiding somewhere in the building. And one day I'm going to find the guy or lady and shoot them. But then while they're around, they keep generating these acronyms. So we got these 5. On the ground in many countries, that would mean multiple country people to deal with. For a client most projects end up being public-private partnership in some way. Imagine having to go through the public side of the bank, separate from the private side of the bank, different due diligence requirements, different underwriting, different people to talk to, different time frames they worked with. We're kind of going through that, and now in 40 countries, we have one country manager. All countries will be one country manager by the end of this fiscal year. So that will change the client equation with us.
Oh, huge.
That's a big difference.
Yeah.
The same way, in the middle and back office, we kind of put together the CFO's office. One treasury is coming together. So the natural hedges inside our treasury books of different parts of the book will come to play. We'll be able to leverage the balance sheet better. We're putting together our knowledge bank, which is a big move. So to me, yes, we're a money bank, but even more a knowledge bank than a money bank. Because our years of expertise, we've got fabulous people who have lived and worked in so many countries in the world and have experience on the ground in building a dam and building a road and building a skilling institute and investing in the private sector and creating a guarantee. But then if they are in different segments, you again get disjointed knowledge.
Yep.
We kind of put that all together, and every vertical, like say prosperity, will have 2 sets of people. One dedicated to regulatory policy and getting it changed to make it business friendly and governance kind of top of scale. Another one dedicated to what I call stealing shamelessly. And for a banker to use the word stealing shamelessly is not the world's best words to use, but they mean everything correctly. For example, if you've done something in a country and it works well, I don't see the reason to reinvent the wheel in 25 other places.
Yes.
We should be able to take that and cut, paste, copy, cut, paste, copy, and then amend for local circumstances. So I'm not being naive about this, but what you do in the private sector is you productize things. We individualize things currently. That's not a good thing. So I'm trying to create these 2 groups of people, 2 different skills. One working on regulatory policy, thought leadership, cutting-edge technology in that space, and one working on stealing shamelessly and duplicating.
We call that leveraging on Wall Street.
Indeed.
Yes.
Indeed.
We would
because
never.
If you called it stealing shamelessly, people would know the truth, right?
Yeah.
So I came out of that world, don't worry.
So can I go back for a second? So with the knowledge, so this is, I
I'm
think,
going to get killed for this.
AI is creating so many cool opportunities, and you know this world better than most. in terms of capturing that knowledge, right? People who spent their lives at the World Bank or in the World Bank institutions, and they retire, and that knowledge walks out the door with them. How do you make sure you capture that as part of this effort? Are you using any digital tools or AI to try to create some system where someone can type into their Claude or GPT or whatever and say, show me this thing I want to leverage?
Yes, that work has progressed quite a bit. And in fact, there's a bunch of people working on, I've created a kind of an innovation lab inside the institution and have incented people to work in teams and come back with ideas, and we judge them and award them prizes, which includes money to actually get it implemented inside the bank. And so I've taken a pool of money and kept it at my level and used that for this. A number of those ideas revolve around AI for a number of things: knowledge, procurement, judging a risk on a project by monitoring everything from satellites to social media to grievance letters to things of that type. Some really cool ideas coming back from people in the system.
Yeah.
And so that's a good thing. There's all that's going on. I think the last thing I'd say on efficiency is that we've done all these things, but we're also working, I think, better with the other MDBs, which is a big part of what I need to get done. I know you guys had Doug and Shriti and others up on the stage just now about the private sector lab, but even for a minute on the public side, in the past, when we got a project and we needed it to be co-financed by two others, we'd have to go and find those two and get them to agree to come in. Then the client would have to go through 3 project approvals, 3 due diligences, and that. Imagine if you're dealing with Tuvalu, which is 11,000 people on an island in the middle of the Pacific Ocean. They don't have people who deal with Asian Development Bank separately from the Australian Development Corporation, separately from the World Bank. So now we're trying to do what we call full mutual reliance frameworks, FMRF, Mr. Acronym. And it took me a little while to figure out they were talking about the same thing I was, but I finally cracked the code the other day. And they said, oh, that one. I said, oh, that's what you're talking about. I got it. And so now that thing is, the idea is that if you're co-financing, if I'm doing the project underwriting, ADB will accept it. If they're doing it, I'll accept it. We decide who's leading.
Yeah.
And one guy does the underwriting, one due diligence, one procurement process, one everything. In the same way, that co-financing, now there's a digital platform we've launched. You can put the project into it. All the MDBs and the regional development banks, KFW, AFT, all see it. We co-finance one time. It's one bid. The client doesn't need to go through 7 hoops.
That's great.
So it's efficiency in the bank, but it's also efficiency across institutions for the client's point of view, from their eyes in.
That's great. So I want to pivot. I'm keeping an eye on the clock, and there's so much I want to cover. When I was here this past spring, there was some discussion around nuclear and discussion, obviously, around energy
I told you I'm
security.
going to get it done. Yes,
and you did. Yes. So June,
although it did
right?
cost me a few hair. And
well, we can't see, so you don't need to tell us.
yeah, that's too much information.
Yeah. So
there's a lot going on here.
I'm sure there's tons. So the partnership with IAEA announced in June, that was a step forward on nuclear. Energy security is a big part of what you're focused on.
Yeah.
The Mission 300, getting electricity to 300 million people in Africa by 2030. Give us a progress report. How's it going? What's next on the list?
So the whole energy thing was, I just think that if you focus on jobs for young people, which is the North Star we've been pivoting the bank to for the last year and a half. Not that we don't care about climate or gender or schools or skills, but all of these have to have a higher purpose. Because if these young people that are coming through the pipe in the emerging markets, which is 1.2 billion young people, will become 15 to 18 years of age in the coming 12 to 15 years. They're gonna want a job.
Yeah.
Because it's the only way they're going to get not just earning, but dignity.
And if they don't have a job, they'll leave the country.
No, either they will do bad things locally, or they will leave the country and become illegal migrants, or that country loses the chance for its own future. And by the way, for us in the developed world, if those were instead channeled into productive growth, think of the future consumer markets. What happened in Asia for the last 30 years could happen in Africa if we tried.
Right.
And Africa will be bigger than Asia if you think about it carefully.
So
the way
energy
the
is
dynamics
table stakes.
If you don't have electricity,
Right.
what are we talking about?
Right.
What clean air, clean water, healthcare, education? Everybody runs around with their hair on fire on a single cause. I'm climate, you're gender, I'm air, you're water. Yeah, like who gives a damn? What really matters is I need clean air and clean water when I'm growing up. I need healthcare and education. But when I'm grown up, I need the dignity and opportunity of work. Whether I work for you or I start my own business. That's what we're focusing on. Electricity is table stakes for that. We went and said we'll connect 300 million people with the African Development Bank to electricity, not one light, one fan, productive levels, computers, refrigerators, that I can open a hair salon. I was in Mozambique and drove up a road and you could see the connections coming from us over the last few years. Was a family that hadn't yet been connected. Somebody who got connected a year and a half ago and now had a chemist and a hair salon. Somebody 5 years ago had a small factory with a chicken hatchery and was providing sort of services for farmers to understand better feeding and technology and managing of chicken illnesses and the like. That's the key there. If you do that well, how do you do that without baseload power? And baseload power requires, you need affordable, accessible baseload power, and you need to do it in a way that manages emissions responsibly. If you do it the other way around, you don't really get easily to baseload power. Secondly, you cannot sit with a straight face and tell me that if Senegal has the opportunity for natural gas in its soil and has got it, I can't find a way to tell them, I won't help you do anything with this. You got to do solar and wind. While we in the Western world produce it and consume it.
Right.
And I think if natural gas is a natural transition fuel as part of your nationally determined contributions to manage your transition, then that should be a fair thing across the world and not unequally applied in different places. If in the process you build a new dependency in a country on importing gas, that's a bad idea. But if they have the resource, so for that country, what's relevant? Is it soil? Is it solar? Is it gas? Is it hydro? So Mozambique again, they have a huge hydroelectric dam made by the Portuguese before their independence. But that same river flows through 4 or 5 sort of hills later. You could put up 3 more dams at a much lower cost because the big dam manages the force of the water, and you could generate 4 times the electricity they got today and use it to export into the regional grid all the way from South Africa, which desperately needs the electricity, into other countries. In the meanwhile, in the north of Mozambique, they have natural gas that Total and Exxon and Eni are working on. So they're the ones extracting it. We're helping with midstream and downstream. Right next to it, they've got huge solar power systems that we've helped to put up. This is a country building a diversified energy matrix that fits its needs, both for its citizenry, but also to fit into the regional grid, which creates corridors, today for electricity, tomorrow for trade. And those are the kind of things we're trying to do with this. Now, in that, nuclear may have a role to play in certain kinds of countries. Those that already have an existing nuclear plant, and you could work with them to extend the life of it. Others where if the IAEA tells me that we could work with them, I want to go with the IAEA because they're the experts in evaluating safety and the right systems. And then work with them tightly. We signed an MOU with Rafael Grossi, so we basically work together on this. And I'm trying to work on the idea of small nuclear reactors with him over a period of time and with my other colleagues in the MDB world. And so that's the whole range of energy.
And what's your time frame? I mean, small modular nukes.
Modular nukes to me are somewhere
5, 10
between
years
3 and 5 years
done?
before you figure out how to coalesce around 1 or 2 technologies.
Yeah.
Till you do that, you can't get to scale. Till you get to scale, you won't get the cost down. So this thing is kind of a circular logic. There are 5 or 6 technologies out there. We've got to stop developing new ones and try and figure out which of these are the best bet to play, coalesce around 2, get those to scale, and then you'll get it to work. You know, people don't know this story, but France, as you know, is highly reliant on nuclear power. How they got there was back in after the Second World War and when they started going nuclear, they standardized on one kind of nuclear technology, one kind of construction. If you came to the government of France and said, I've got a whole new thingamajig here and I can make it this way, they would say, come back after 3 years. And if I came back and said, I'm just copying what the other guy did, they would give you permission in 6 months. That's stealing shamelessly. That's really important. That's how they built their nuclear system at that time. And I think standardizing, getting costs down, and through scale, kind of what we did with, computers and phones and batteries and solar cells and computers, and that's the idea.
So you said,
but you're still a few years away.
You said the word standardized, and the panel before us also used the word standardized in a slightly different context, which was the private investment lab. And we've been talking a little bit about the private sector getting involved with a number of things already. When I was coming down here today, and some friends of mine who work in investment houses that trade bonds, they were so excited about the CLO. So excited about the CLO. And I know the panel covered this in some detail, so I don't want to...
anybody else who gets excited about a three-letter word called CLO.
No. This was exciting because they want to buy this debt. You think about this year. This is a fascinating year, Ajay. You have emerging market bonds outperforming most developed market bonds.
Yes.
You have emerging market equities outperforming most developed market equities by a lot, partly because of the weaker dollar, but even without it, by a lot. And so the idea of having diversification and different types of instruments is exciting to people.
Yeah.
So we heard from the previous panel, but I want to hear it from you as well. What's next? Can you scale it? How long is that going to take?
And you're going to compare what I said compared to what they said.
Yes.
So you'll know how much Doug Peterson was bullshitting you, right? So Doug and I are very old friends and colleagues. We've worked together for 25 years. And I really am grateful to all of them for doing this work for us. They've got other things they could be doing, and they're spending a lot of time, Shriti and him and others, on helping us. So don't get me wrong on the jokes. But I'm like, I've got to keep myself smiling, otherwise I'll shoot myself. So the private sector thing is very simple. There is not enough money in governments and MDBs, even earlier. Forget about today's challenged fiscal circumstances in the developed world that we're all reading about. But even if you go back 3 to 4 years, there is not enough money in government coffers and MDB coffers. If you put us all together to meet the challenges of infrastructure, healthcare, agriculture, jobs, and the like for the emerging markets. We have to get the private sector's money, ingenuity, and technology and talented people onto the table. Second, the reality is that 80 to 90% of jobs get created in the private sector. Governments enable. Early on in the development cycle, governments help to generate. But eventually, even in the United States, jobs come from the private sector. And within the private sector, the overwhelming majority of them come from medium and small scale enterprises. They may rely on large companies to get the wherewithal for them to grow, whether directly or indirectly, but that's where the jobs come from. If that informs you, then trying to plow your own furrow yourself is not going to be a good strategy. So that's where the private sector lab idea came from. How do we catalyze the multiples of money that we need? Today, this year, we've mobilized 69 billion of private capital, and another 70 odd billion in bonds. Private capital is bought into our bonds. That was 49 billion the previous year. Yeah, and next year it'll be 75. We've got to find a way to get to 200 and 300 and 400. And therefore, we have to think about this quantum different than doing things better next year than last year. Right? That's the insight into this thing. So this private sector lab came back with 5 recommendations, and you've heard about some of them, but the first one is relatively simple. Can I, as a private sector investor, get regulatory clarity on the ground? Will I get paid? Will I be able to take my money out? Will I be able to get labor easily? Will I get right of way to lay my digital cable? Things like that. Which we can help with, because our knowledge bank combined with our financing, where we pay for results, is you change the law and we'll give you the money, kind of thing. That's what we're doing for the 300 million being connected to electricity in Africa, for example. The second one was, even if I do this, I need political risk insurance, because governments change and they change their mind. With this thing called MIGA that we have, actually does that. We've consolidated all the insurances that we used to do in different part of the bank in one place. One system is now doing it. That's up 30%. Again, original target was to double by 2030. Shriti and I both agree that we can do that faster. And we're just going to do it one step at a time and try and get it done quicker. The third is, doing all this is great, but I have a foreign exchange problem. I'm investing in dollars, euros, and yen. I'm getting paid by a local utility in Indonesian rupiah. And my investment is a 20-year investment, and my repayments, therefore, are in Indonesian rupiahs, and that's a hedge that I cannot get. You can't get a 20-year. You can't get a 20-year hedge for the euro. Right. What are you going to get for the Indonesian rupiah? And so how do I cover my exposure? ISC is now up to 33% of its financing being local currency through swaps and bonds we're raising locally. We're working on local capital market development in 20 other countries with the IMF. But we've got to find more solutions, because this still doesn't meet the need of these investors. The fourth one is, you do all this, I still think the risk is here. If you take first loss, can I bring the risk down here so the investor will come? First loss as in junior equity or capped returns or whatever. So we've set up a first loss fund. I can't call it a first loss fund because that's not good marketing. So, so we called it the Frontier Opportunities Fund.
Beautiful.
Which, of course, that acronym guy called FOF, which is not a good acronym, but never mind. So we set that up with our own retained earnings to start with. If any of you have friends in philanthropy, please send them my way. This is the time for them to put their money where their mouth is, because they keep talking about incentivizing emerging market investment. Ask any private investor, first loss is the way to go at it. Mark Galogly is doing amazing work in that space. He's a part of our lab. You should get him on stage sometime. He's fun to talk to as well.
Oh, good.
And then the last item is the originate to distribute part, which Doug is leading for us. And the idea here is over time to create an emerging markets asset class, over time. Please don't, I really mean this over time. I think this is a 4, 5, 7-year effort. But we've had great progress with one securitization to test the waters. It did really well. We're trying to figure out how we can work with the other MDBs, the private sector parts of them, to originate enough flow so that these receiving entities, a pension plan, a asset manager, can see regular purchasing opportunities. And then trying to figure out if we can do this in a way where rating agencies get involved as well, and so it becomes a package security. As you know, Canadian pension plan is not going to underwrite each loan. But if you come to them and say, here's $5 billion a year of exposure to infrastructure in Africa, and it's A- paper, and Standard & Poor's, God forbid, or Moody's, or the other competitors that you had, one of them underwrites this and agree to do so, and give it an A- rating, and you can buy it at 92 cents on a dollar. The CIO for CPP will say, that fits my profile. That's what we're trying to get to. That's the real pot of gold at the end of the rainbow.
And you're not going to leave till that happens, right?
This is a good place to end.
So all I will say, and you know this too, there is so much demand for that. Yeah. So the sooner we can make that a reality, the better for the world. All right, it's all up to Doug.
Yes.
All right, Doug, it's on you, man. We are out of time, and I want to be respectful of your time. I want to thank you again so much for always joining us and being so candid with us, and thank everyone for being with us here today at Bretton Woods Committee at the IMF, and we'll keep the show going.
Thank you very much.
Thank you very much.
Thank you.
Thank you.
Good afternoon. And last and absolutely not least, we're in the Managing Director's house. Thanks for inviting us all, and thanks for taking the time, as you have every 6 months, to review things with the Bretton Woods Committee and its membership, give us a sense of where things look to you, how things are going with the fund. And certainly, considering, among other things that have happened in the last 6 months, the economies have shown more resilience than had been expected. And so, nonetheless, there are a lot of challenges in the air. Hardly time to take comfort with the resilience shown. But today was the release of the wheel, and perhaps you could give us some insights about the prospects and particularly the explanation for the resilience and whether we should count on continued resilience.
Thank you very much, John. To those members of the Bretton Woods Committee, this is your house. You're always welcome here, and I always enjoy having these conversations. One observation I would make is, John, that the 6 months are getting shorter and shorter.
It feels that way.
It feels that way. Let me remind us when we were here 6 months ago. At that time, the concern was that we would see a more substantial slowdown in the world economy.
Yes.
I remember vividly journalists time and again asking me, "Are you sure there is no recession on the horizon?" And me answering, "Well, in our baseline, we do not see a recession, although, of course, there were and there are still downside risks." Now we have slightly improved our projections for this year and next vis-a-vis April. When we look at the 1 year back, we were at that time projecting for 25, 3.3%. Now we are saying 3.2%. It is a minor downgrade. And so the question on everybody's mind is, what is anchoring this resilience? Where does it come from? We have looked into the data, and we have done actually a very substantive review of emerging markets performance. And we came up with 4 reasons for why the world economy has proven to be so resilient. The first one is the most important one. Over the years, since the global financial crisis, countries have taken very serious steps to build sound macroeconomic fundamentals. Good monetary policy, independent central banks, good fiscal policy, in many countries fiscal councils, fiscal anchor, and more interaction with each other that allows policy coordination to reinforce individual countries' actions. We looked at emerging markets. There is a chapter on that. And what it says is that emerging markets are in a better place to withstand shocks because of those policy investment. And those that have made them, if a shock hits, they would have 0.5 percentage point higher growth and 0.6% lower inflation. I am definitely on the view that the message from this source of resilience is very simple. Stay the course. Stay the course. Second reason for resilience, again, very interesting to see how private sector has buffered the impact of uncertainty and the impact of tariffs. More broadly, over the last couple of decades, the fund, the World Bank, many policy gurus have been urging countries to get the state out of where the state doesn't belong. Don't take on you to provide electricity, water, sewage, produce metals, and be everywhere in the economy. Let the private sector do most of it. Of course, provide regulatory framework, regulatory certainty, but get out of where private sector can be more impactful. And now we see that indeed the agility and adaptability of private sector helps buffer countries at that time of more uncertainty and shocks. Just one example, tariffs are announced, private companies rush and they buy everything that they can possibly buy, deliver it before the tariffs start to come in effect, and then they take the time of this buffer to actually see how they can realign supply chains. The third reason of resilience is very important, and this is one where the story is not yet written entirely, and we, during this week, hopefully would help it to be written. So the US in April had announcements that accounted for 23% tariffs.
Yeah.
We are coming today, after the negotiations, the deals that have been agreed, the tariff rate is 17.5%. The effective tariff, though, what is being collected when you get exceptions to accommodate the need for the economy to function well, we calculate them somewhere between 9 and 10%. So the burden is more than twice less than we thought it would be then. Mm-hmm. Most important, though, is not this. It is that the world so far, and I cannot stress enough, so far has opted not to retaliate and to continue to trade pretty much on the rules that have existed. So when we look at the behavior of countries, that is, I think, very mature behavior. If you are a smaller, open economy, why would you want to get into tit for tat and then a trade war in full speed? And I think the question for all of us is, what is going to happen next? Yeah. We are calling on our members, be rational, do what is good for you. If you are a smaller, more open economy, obviously sustaining a vibrant trade is in your interest. There is also a fourth factor, and it is financial conditions. They're accommodative. So you need money, you can raise money. In fact, what we're seeing is something that I would get there in the category, well, not quite yet out of the woods. Yeah. We are seeing also the dollar depreciation, relative depreciation. It is helping because if you are an emerging market that borrowed in dollars, it is now cheaper to serve your debt. However, so we say better than we feared, but worse than we want it to be. Why worse? For two reasons. One, growth is still relatively slow. And two, debt is very high. So these two things are a huge headache. And we are in this week, we will be talking with countries on the importance of fiscal consolidation, medium term, do it carefully. Obviously, you have to pay attention to your people and how you bring them with you. And then, of course, structural reforms to lift up growth prospects. So it is easier to deal with the debt upon you. Where we see a risk that could potentially be of the magnitude to create more problems. In other words, we are saying, yes, we are resilient, but this resilience has not been fully tested yet. Is when we look at valuations. So they're stretched, and they're particularly stretched in one area, investment in tech, in artificial intelligence. So this is a bet, a very big bet. If it pays back, fantastic. Then our problem with low growth is gone. because we would see increase in productivity and we would see increase in growth. What if it is either slow to come true or doesn't quite materialize? What then? What if people panic and say, oh, I put all my money there? And then we have other new things that are a big force of potentially creating risks, like digital money, stable coin, very big pickup. Actually, we had a seminar today on the future of finance, and I was reminding the audience that in 2009, Bitcoin came to life. For the next 2-3 years, it traded 1 cent per Bitcoin. And then it started very slowly moving up. And I was asking the audience, how many of you are saying, why didn't I buy $100 worth of Bitcoins then? But when you look at the progression more recently, I mean, this is now a $4 trillion asset. Bitcoins, yes, only 300 billion, but they moved from nothing to 300 billion so quickly. So there are things that are happening in a world that is changing very rapidly. Geopolitics is what it is. Technology is advancing very quickly. Demography is a huge potential risk because we have one part of the world aging and shrinking and another part of the world growing, and the money is where? In the part that is aging. How do we, I'm sure Ajay talked to you about how do we make it so that money goes to create jobs where jobs should be created. So that's our story of the week. I read the media, how they react. So half say, oh, it's worse than it should have been. The other half says, oh, it is better than we feared. So I think we got it right.
Excellent. Now, you brought up digital finance. It seems clear that changes are occurring in the financial systems, and expectation not just in the advanced economies, but one that will affect everybody. This is the monetary fund. What role should the monetary fund be playing in the evolution of the new digitally oriented financial system?
I actually was asked this question today, and I would give you an abbreviated version of my answer. Our most important role is to make sure that the 191 members of the fund can see this development from the same vantage point. In other words, our bilateral surveillance, our multilateral surveillance, giving a sense of what is happening in the world, and then drilling down to what does it mean for your country. And there, I think the work of the fund on understanding what would make for good regulation, what would make for good standard, how we harmonize across the board, even if there are different regulations, they're compatible. Dealing with the 3 big risks that countries are going to face. Risk number 1, interoperability. If we end up with platforms that don't talk with each other, so you have something here, something there, we are fragmenting the global financial system. Big problem, obviously, for an institution like the fund. Secondly, monetary sovereignty. It is possible that maybe we would go in a world in which there is much more financial integration across countries, and maybe that would lead to some changes in the monetary composition. Not maybe, it is very, very likely it will go there. But would that be chaotic, or more with some vision and movement that protects countries from being the holders of the short end of the stick. And that monetary sovereignty is something that for quite some time, to be frank, we were talking about like this is the boogeyman. Boo, it is coming to take away your monetary sovereignty. I think we need to think about pragmatically how we see the development of digitalization. It is happening in fiat money, and it is happening in non-backed and backed, let's call it crypto. It's happening in across the board. How we think about the impact it would have on monetary policy in small, even medium-sized economies, large economies, what does it mean? This is our job to figure out. And last but not least, train staff in relevant institutions on what is happening, and then be the transmission line of experience from one place to another. I am impressed by how many of our members are venturing into piloting. I met the Kazakh delegation, so they have a pilot on CBDC, and they have a pilot on stablecoin tenge. They may not go anywhere, but that kind of development, there is nobody else but the fund with the universal membership that can help countries learn from each other. And I can tell you that demand for our support for the membership is skyrocketing. How can they handle this rapid transformation?
Yeah. Is the instrument by which the fund will be interacting in this area the financial sector assessment programs, the FSAPs, or some new or different initiatives?
So the FSAPs are very useful, but they come every 5 to 10 years. This train is moving. I cannot call it train. No. This not even plane. This
rocket ship.
Zip. This rocket is. So we have to think more actively how to use bilateral and multilateral surveillance, because they have the right frequency for us to see what is going on, what is happening in the regulatory environment, and then help countries see the same picture at the same time.
Yeah.
Which, by the way, one big thing we are doing this year is the comprehensive surveillance review. And I can tell you this is where we need to think through all these questions and how we can be equipped to answer them.
Mm-hmm. How will you go about this, conducting the review?
I mean, as always, when we have 3 big reviews: the comprehensive surveillance review, the review of conditionality, and the FSAP review. And as always, when we have reviews, we do quite systematic and structured consultation with the membership, with the expert community, with the CSO community, so we can get perspectives before we go. We do very thorough analysis of past experience. So we would look at what have we learned from programs, from surveillance, from FSAPs. We actually presented to our board the stock taking on a review of conditionality just last week. And then we would get all these inputs, and then we would work on what do we believe is working well, so don't touch. Where do we need to go on the surveillance review? Another thing that is coming that we need to assess and see what we do about it is regional surveillance. The world is regionalizing. Yeah, it is a multipolar world. So you have some regions that are now discovering that they can go in deeper integration. ASEAN, Gulf Cooperation Council. Should we continue to do bilateral surveillance and multilateral global, or we need to plug in where this matters, where these forces of regional integration, trade integration, financial integration are so potent that for our understanding of direction to travel and for our support for the countries, we have to do more. As you probably know, we have one really deep instrument. This is the Euro area surveillance report. In Africa, for the countries that have monetary union, we would do lighter touch, but a similar thing. And maybe we have to move in these three layers, bilateral, where it matters, regional, and multilateral. But these are answers we have to answers we have to find, mindful of our resource constraints. Because one thing I want to say to the Bretton Woods Committee and friends, one thing I'm very proud of is we have committed to flat real budget. Our budget today is what it was 20 years ago. When I'm leaving my position, of course, you never know, so don't swear on that. But I'm hoping to look back and say we prioritize with the same resource, we prioritize in a way that we have highest impact of our work and we remain this very tight organization. John made us like this, a very lean organization.
We prepared for the global crisis at the request of our membership by reducing headcount by 10%. Now,
yes, here. And since then, flat.
Now, you hear a lot of talk are the MDBs, especially the Bretton Woods institutions still fit for purpose. In this review, are you finding good engagement among from the membership?
Yes, yes, and I can tell you that the higher the uncertainty, and uncertainty is the new normal for the world economy, the more our members seek the opportunity to talk with each other and to engage with the staff and management of the fund. I just went, this is my second day of the week, and I have had already 4 regional meetings. Everybody is there, central bank governors, finance ministers. Everybody wants to hear how we see the region, how the other countries see the picture in the region, what does it mean for them. So I'm very, very proud with the staff of the fund because we work. Are there staff of the fund in this audience? Staff of the fund here.
A lot of ex-staff.
No, ex-staff. I mean, this is such a disciplined organization and so much with that sense of institutional responsibility. So yeah, I think the membership appreciates that we are there to say, this is how. So we kind of go, here is the fog. And through the fog, this is what we see. And with their help, we see better.
And the membership's responsive.
We see further, yep.
In other words, with all the risks, maybe someday soon demands might be financial, but at this moment, it's more intellectual, analytical.
It is actually also financial. I mean, I was with the Africa Caucus. We have 26 programs on the African continent. Many of them not trivial programs. We have close to 50 programs, financial programs mostly, a couple of non-financial arrangements where the countries ask the fund, they don't need the money, but they ask the fund to be the anchor, the disciplining factor for their policies. So it is financial. We did a review of the global financial safety net. 2 conclusions. So far, so good. But so far, so good because large economies, at the time of shock, deployed huge amount of monetary and fiscal support with spillovers to the rest of the world. Do we still have that? Countries are now advanced economies up to here in debt. If there was to be another shock, how do we cope? And this is where we actually have to relentlessly strengthen the global financial safety net. And I can say I'm very encouraged by our membership committing to the 16th quarter review, the 50% increase, and very grateful to Secretary Bessent for Treasury making this also a priority for the US. So why does it matter? Because when you look at reserves globally, 10 countries hold 2/3 to 3/4 of global reserves on one end. And on the other end, we have 100 countries with somewhere between 3 and 5% of global reserves. They rely on us. They rely on our ability to work with regional financial arrangements to bring more strength of the global financial safety net. And I think the membership would like us to continue to be watchful. Mm-hmm. Do we have that capacity to withstand shocks?
Mm-hmm. Well, sadly, our time is coming to an end, but
oh,
it's always this way. It's always this way. We can keep going a long time, but I can't resist. Mm. This institution began to administer, to create the gold exchange standard that went away. One of the big surprises just in the last 6 months is the price of gold. What's going on?
I don't think it is a surprise. I think when there is uncertainty, human nature is what it is. We lean to be supported by the known, and we know gold. I mean, both businesses and governments, businesses, individuals, they're saying, maybe I should be propping up my insurance, my own insurance. I think we may be over-insured now on gold. From the position of the fund, as you know, we have gold reserves. So I'm counting
getting richer, getting a lot richer.
Yes.
As good as Bitcoin. But well, hopefully, the theme when we gather, hopefully 6 months from now, that once again we'll be able to talk about resilience, but it may be risk. So
yep.
I think you're in an audience that appreciates the work of the fund. Oh, before I finish, we have a brand new FDMD.
Yes, we do. He joined us just before the annual meetings, Dan Katz. Very smart, very committed to the work of the institution, and so far doing very well, engaging with the staff of the fund and engaging with the membership. So you will see him. I said something today about him, and he was a little bit of, I think he took it as offense. I said, thanks to Dan, the average age of the management has come down. And I really meant it as a huge compliment.
Yes.
And he's really very energetic, very fast on his feet with very good judgment.
Well,
so, yes.
We wish him good luck.
I told him he needs to talk to you.
That'll raise the average age again. But you're in an audience that appreciates this institution, appreciates the work that you're doing. I wish you all the best, and thank you for spending time with us today.
Thank you. Thank you, John.
Thank you.